Good morning, ladies and gentlemen. Well, the model score decreased slightly on the week to 44. Nothing to be particularly worried about as of now, but let's have a look at a couple of things in the attributes and the aggregate spread ratios which have struck me as significant. If we go to spread ratios, aggregate, I noticed this dispersion, which is very large, really. So the intermediate to long-term relationships are very mixed. That's what it means. Many relationships have lost their 50-day moving averages, but have not lost the 200-day moving average, is the implication. And the relationships are still trending strongly on a medium-term and long-term. And these ratios trending strongly bearish remain international ratios and equal weight ratios. And if we look at the realized volatility across spread ratios, it's completely normal. Nothing is probabilistically going to break when realized volatility is not expanding materially. On Friday, it actually decreased. And the only ratios which are driving the market are breadth, various risk-off to risk-off. But risk-on and risk-off and technology ratios are showing great stability. So what it shows really is this remains a story of rates breaking the smaller players, the ones that need to refinance and the ones without a moat, i.e. basically the smaller players for now, are the ones suffering and will continue to suffer. If we then go to model school research, what has struck me particularly is now the difference between the 10-day and the 20-day realized volatility probabilities. This tells me that we are probably going to go sideways for a couple of weeks, and then there is going to be a thrust in one direction or another in equities, i.e. we are going to be relatively calm in terms of realized volatility, and then something big is going to happen in about 2 to 3 weeks' time. If we scroll up to the model bin realized volatility map, while we are in this bin, it basically says that market returns are completely average and there is nothing much to look forward to. So I would have thought a period of stability for a couple of weeks before we either trend into risk off or we continue with risk on. A period of indecision, and let's have a look at what the bond market is saying and what the Fed did on Wednesday to find out what it is that probabilistically will happen from now on. You'll remember that I was basically looking for a 25 basis point increase in the dot plots. These are the new ones and these are the old ones for your reference, so you can refresh your memory. In fact, what did we get? We got the majority of the FOMC still looking for one rate hike in 2023. And actually they reduced the amount of easing they think they're going to be able to do in 2024, not by the 25, 30 basis points that I was looking for, but by a full 50. What actually still strikes me is the amazing spread that we are looking for in 2025. But everyone has revised their dots higher by at least 25 basis points. I assume that Powell is somewhere around here, somewhere around straddling 4%. So you can see that the results of the dot plots were far worse than I thought. while the longer run remains stuck at 2.5%. Some people raised it, as you can see, which makes sense, but this is the bit that makes very little sense. If all these dot plots are going significantly higher, so should these longer run ones go a little bit higher. But here we go. What they're basically saying is they feel that it's very unlikely that they will be able to, I wouldn't even say decrease rates. I would say it's very unlikely that they will be able to cut rates at any stage in early 2024, and that any cuts are going to come in late 2024, and then they see how things proceed. Basically, I think what they're saying is that they would like to be done, but that they will keep rates at an elevated level and therefore make the real rates rise over time, because they would rather sacrifice a few 100,000 jobs than allow inflation to roar again. And that is good. But on the other hand, I think the likelihood of them being able to keep rates higher for longer and real rates higher for longer without eventually breaking something has probably decreased. On a fundamental basis, what they are actually saying is they would like term premium to go positive. If you're going to keep rates elevated for a very long time with the risk of even further hikes, why would the term premium remain negative? Very little reason for it to do so. They would like this term premium to go higher, and higher term premium means lower equity valuations. If we then look at the real rates, you can see that they are rising. And if we have a look at historically what that is, you can see that real rates, real 10-year rates, are now back into levels they were last at in 2007. So you can see what the risks here will be, but this is what they're saying, and this is what they're saying they want. Will they like it if bad things happen? I don't know, but as you can see, they are and wish and want real rates to remain high to reduce the possibility of inflation accelerating again at any time. And to do that, they're probably willing to have slightly higher unemployment over a certain period of time, just to make sure that things don't get any worse than the inflation that we have now. How did the yield curve respond over the course of a week? Well, the 2s are 15 basis points higher. The 5s are 18 basis points higher. The 10s and the ultras, really, that's probably the better way to look at it, are about, 16 basis points higher. And here we have the bonds, the long end, up, 15 basis points. So it's almost a parallel shift, slightly more in the belly. So let's have a look at what that shows us and predicts for the way the 2s, the 5s, the 10s and the 30s are likely to trade. To me, the 2s are now quite stuck. The problem is that now they're gaining a lot of optionality. We are very close in yield, this is the cash yield as opposed to the future yield, to a level whereby there is very little negative carry of any sort here. I think the market thinks that the Fed would love to not hike again, just like the BOV didn't hike, just like the S&B didn't hike, just like the BOJ was not as bearish as people thought they would be. So the market thinks obviously that they would like to keep rates here at worst for a long period of time before they start easing. So I think the odds of the 2-year note going the other side of Fed funds are very, very slight here at this time, unless some incredible piece of data comes out and says that they need to start hiking very aggressively again. I just can't see that. I think the odds are very low, which basically means that if we ever see 527, we have to buy it, or we have to buy call spreads, or we have to do something to get long of this, because the odds are that we will be trading in this 499, 527 for a prolonged period of time. In fact, I don't think it'll even come below 503, 504, and probably won't touch 527 unless we see something very, very bad. So what I'm saying is that twos are absolutely stuck in a very tight range until we get some data which resolves the issue whether they can hike again or not. I certainly think they would love not to hike. And don't forget that the twos have very big optionality here, because they will move quite strongly, or the inflows into twos will be very strong if at any stage the stock market starts imploding. I think the odds are small, but the optionality in the twos is there, and therefore I really don't think that the very short end, like 1 year, 2 year, 3 year, is going to have much movement from here for the foreseeable future. I think it's a different story for 10s and 30s, simply because they will be affected by supply. We have, 130 something billion worth of 3s, 5s and 7s this coming week. And then the week after, we start getting the long duration stuff. I just can't see 10s and 30s doing much better than they are doing. Yes, on bad numbers, but we don't have any data next week. So it's really going to be a factor of continued supply over time. Because don't forget, just because we, digest the auctions in 2 weeks' time, well, there are more auctions behind that, and more behind that, and more behind that. So it's just going to be, to me, a factor of supply. And any time that we dip to some sort of support level because we got some piece of data that implies the economy is weakening, or stocks came off, or whatever it is, I think the odds are that you have to again look for the steeper curve. So what I'm really saying is that the curve is going to pivot around the twos area, and basically the twos are going to remain stable, and for the curve to move, it's going to have to be a 10s move or a 30s move, because the movement in the twos can only be 5, 6, 7 basis points either way, until and unless it's a stock and risk off move, and then the twos can do a lot better relative to the 10s and 30s. But until then, I doubt very much that the twos are going to move. It's going to be a probabilistic move of the 30s flagging and then going up. I think it's very unlikely that the 10s and 30s sustainably move lower. I really don't see any reason for it, and I think supply will make sure that we return to higher yield levels sooner or later. To me, the implications of what I've told you so far is in 10s, 10s and 30s, 30s cross US Germany. You can see how the natural tendency, every time it dips, it goes back towards 173. I don't think this is real. Okay, I don't think it busted through and came back. I could never trade it. I mean, it was there for like a millisecond, and I was actually asleep. It happened like at 2 o'clock in the morning, Eastern Standard Time, and it very quickly reversed. So this is rubbish. It never really got through 173 or stay there for any length of time. So you can ignore that, but I think every time it dips, it's just going to keep on doing that and going up. I think eventually we have to retest this at least 182 to 190 area. And if we look at 30s, 30s, I think eventually we get up here towards the 190s. The supply in the US will continue to be there, and that's all there is to it. If we look at the German yield curve and see what's going on, you can see that absolutely nothing is going on. I think the same thing that I said about the twos in the US applies to the shats. I think the ECB would now very much like to be done, and therefore, the shats are just going to trade around, maybe test this 340, come back off. But this is going to be very boring in terms of realized volatility. And you can see how much less volatile the Bund is rather than the 10-year note. And I think that relationship is going to continue. Every time the Bund dips, it'll get bought up towards 290. But the 10-year more so. So I think the bigger opportunities are going to be in trading the spread between the two rather than trading the outrights. The one we actually need to start watching is the BTP. This is a weekly chart of the yield of BTP. And you can see that it's breaking up. Don't forget, this is a weekly chart. We remained in this very tight range for many, many weeks, in fact, since almost the beginning of 2023, and it's breaking out. And you can see how important 485 is. Look what happens every time it breaks upwards from 485. I mean, this is the least that happened, and that's, what's that? Nearly 40 basis points, and sometimes it just goes and goes 300, 400 basis points. So to me, that's a very, very important level, and one that I'll be watching very carefully. If we change that to a 1 day, you can see that we're beginning to trend up. So I think any dips in BTP towards the 440 level, you start doing some Bund BTP or outright BTP short. That seems to be the risk reward, that we start breaking higher. And it seems to me that the market is basically going to punish anyone who needs to issue a lot. The less the issuance, the less the pressure. The more the issuance, the greater the pressure. BTP, US, to me, those are the places which are in danger. To me, the dollar is a symptom of no one being able to out-hawk the Fed. Everyone else wants to keep rates steady at worst, while the Fed has the power to keep rates much higher for much longer than the market even would like, or even other assets would like. And that basically unleashes the possibility of the dollar getting stronger and wrecking things. I don't think it's going to go immediately higher. I think it's more likely to consolidate for a few weeks. But these charts, and especially this weekly chart, I mean, we've gone up how many weeks on the trot now. And basically what that says is there's an inherent demand for dollars because dollars are what the differential of the interest rate is so big and likely to remain so big and even get worse that people want to buy dollars. And I don't think that's going to cease. Could we see a little bit of a pullback again to the levels that we saw, at the beginning of the week? Yes, for sure. And I think it'd probably be healthy. It'll turn all these moving average on the dailies. I don't think it's going to go straight out there and bust 106.25. But on the other hand, I think that any 100, 200 point dip is going to be a wonderful opportunity to buy it again. To me, the dollar eventually breaks a lot higher. Gold is an interesting one because what is it doing? On an outright basis, absolutely nothing. But on a relative basis, it's outperforming bonds and it's even outperforming equities. I think it's being used as a diversifier. People are buying it to diversify away from bonds and some equity risk. I think it's really that simple. And because it's a small market, it's very easy to keep propped up when there is that kind of buying flow. Do I know which way it's going to go? It's more likely to go higher than it is lower unless bonds really do a ridiculous, moon jump in terms of yields, which I don't expect. And therefore, I expect the dips in gold to be bought because if there are diversification flows, the dips get bought and eventually, it breaks a little bit higher. Could it go and test the still upward sloping 200-day moving average here around 1985? Absolutely. But I just don't think that this is the start of a trend in gold. I think it's just a diversifying flow. DBC basically did nothing. It closed slightly weaker on the week, but I think that what I said, that these levels here around the 26 area are going to be very, very difficult to break. And therefore, I think what is happening in gold also is that there are some flows out of other commodities into gold. The long-term moving average is still pointing upwards, so I really wouldn't be surprised to see these levels again in gold DBC, which basically means that people are buying gold and selling commodities in general. And oil, I actually sold into the 92s. I was lucky. I think what I said last week, that this is roughly the top in oil, is probably true for quite some time. I think it's more likely to trade 85 before it breaks higher. But, I think it's going to be a nothing burger for a couple of weeks. And then we will see if it can break up. And that is why I think it's probably unlikely that we get a big move in bonds either for a couple of weeks, because I don't think the pressure from the sort of the inflation hawks is going to be, there, because there's going to be no reason for it to be there for at least a couple of weeks, but we will see. So that's how I tie in the price of oil and the price of other commodities and the price of gold. The gold should be favored here as a diversification flow and relative stability in the other commodities as they get sold relative to gold. If we have a look at the Blue Angels, you can see that they are now on the times 18, which is a more normal valuation. What I still dispute is this period in which we revised upwards the 2024 earnings so strongly, 12-14%. Will that be able to hold? I don't know, but I think we're in for a couple of weeks of relative stability. Whenever the market hits this times 18, you can see on the way up, it backs off, but on the way down, it, it bounces off it. I don't think the next couple of weeks are the weeks to see some kind of big fall in equities. I would expect a normal trading range in equities from the fundamental side of these blue angels. Let's now have a look at the technicals and what they say. So this is the clean chart, and I have very, very clear and important support at 42.55. To me, 42.55 is going to be some sort of a line in the sand. I think it's going to be very, very difficult to break. I mean, after all, it's still best part of 70 points lower than we closed on Friday, and it's about 1.5%, right? Or 1.75, whatever. So to me, that is going to be the very natural support and where I would actually like to buy it for a bounce. So 42.55 to me is the line in the sand, and we'll do some call spreads there. On a daily chart, we are through the Bollinger Bands on the low side. How do I interpret that? Or I interpret it like this kind of period here, that we might get another couple of days, probably in the middle of the week, where we test the lower levels. We have the 200-day moving average coming in here, and it should catch this 43, 40, 50. We have a gap down here to 42.20, but I think that this is all she wrote for next week, and then you get a bounce. I think it's going to be two-way trading as opposed to just selling like we had after the Fed. I think it's going to mitigate and slow down. If we now switch to the 195-minute chart, it's very much the same as the daily chart, and this is the 200 period of moving average, and it's still going higher. So I expect a dip to about 42.50 to catch it, and then a back rally, or we'd go straight up to 43.80, something like that, and then come down. In any case, I think it's going to be a period of relative stability over the course of the next couple of weeks. We have the month end, and then nobody's really gonna know what to do in the early part of next month. I think the critical part is actually, in over 20 days, I think what I showed you in the model is correct. It's going to be something longer term which trips us up in one way or another, rather than something that we know now, because we do know now what the Fed dot plots are and what the Fed's thinking is. We just don't know how realistic it is, and to find that out we need data, but data that we're not going to get in the next week. Also, what I notice is that that VIX isn't even back to the levels that we had in late August. And if you have a look at where we were in late August, we were here. So basically we bust through here in the SPY, but we haven't bust through in the VIX. So there's a little bit of a divergence there. We have the 200-day moving average coming down. So even if we bust through on the downside in SPX, I think we're coming back, because I don't think volatility can expand as much as it needs to, and also because I think a lot of people will be buying sub times 18 on the Blue Angels. It's just what it is. It's a technical period. I think we will find out which way we'll ultimately go when data comes out, because at the moment we just don't have enough to decide which way to take the SPX sustainably. And this message is reinforced by what Europe and Japan are doing. They're just trading and bouncing off the bottom of the Bollinger Bands, both in the dailies and the weeklies. I think it's going to take a long time for these Bollinger Bands to expand and allow a big move, down, unless an event happens, and that we can't predict. absent that event, we need real data to get these markets moving. And I don't think that we're going to get it over the course of the next week. So I'm probably a better buyer of dips in everything. If we look at the Nikkei, what's it done? I mean, just came very close to the bottom of the Bollinger Bands and then, and then rallied. So I don't think the international markets are going to allow for a big move down in S&Ps or Nasdaq next week. It's just very unlikely to me. The only chart that is concerning for equities is actually the small caps. But small caps are such a small part of the universe. And what basically this chart is saying is that under the surface, things aren't good. The smaller companies are suffering. They don't think that the economy is going to do so great. And really, the can is being carried by the big caps and by the Magnificent Seven, and that everything else is, pretty much down in the dumps. These are the lows for the year. Okay, so we're not that far off the lows for the year. If the lows were 170, let's call it, we're at 170, 176. So that's like 4% off the lows for the year. And if you look at equal weighted S&P, that's only up 2.8% for the year. So how do we square this? Well, we could have a bit of a movement like here, where we get to this level and then we bounce and we re-see a test of 179.40, 180, and then we come down. But again, even this chart is saying that the big move isn't going to come in the next 1 or 2 weeks. Can you get a continuation move, another couple of percent down? Yes, I think you can. But I don't think you're going to get, a complete collapse even in the Russell. But certainly the Russell is the one that is by far the weakest and the one that technically you know where to sell. I mean, you basically sell this level or you buy puts at that level, and you look for it to outperform on the downside the big caps. I think it's really going to be this simple. I can't see anything else that's going to immediately cause the big caps and the big technology companies to come down over the course of the next week and stay down. I think it's going to be a trading week as far as equities are concerned. I've changed all the levels that are appropriate, and I think the only thing that we can look forward to next week in terms of trading is an opportunity to sell the US against Germany, or do some Germany BTP at the levels that I mentioned, or if we get a really bad downdraft in equities, try to buy some call spreads at that level. But I think that's probably all we're going to get in terms of big market opportunities. For the rest, it's just going to be a normal range trade in bonds, I think. Very much contained. I don't think that people can rally bonds very far because supply is just around the corner. I mean, after all we have done is front run the supply. We're not going to rally into it without a very good reason, and the very good reason can only come from data, which we aren't going to get next week. So I think the upside in bonds is quite capped, and if the upside in bonds is capped, then I don't see why the relationship to other assets should really change all that much. Thank you very much indeed, and tweet you on Monday.